We started out this week with some manufacturing numbers, and on the surface, they're actually quite good. But digging below the surface, well, that's a different story. And it's quite interesting considering we have a Federal Reserve meeting in a couple days, and the expectations all of a sudden have changed. Starting out, Empire Manufacturing Index expands in the New York region for the first time in almost a year. The numbers actually look quite good. This is the Empire State Manufacturing Index, the main number at 11.5. It's the first positive number we've seen in quite a while, actually going back to November of last year. It's a volatile number to say the least, but this certainly is a good development. Now, digging below the surface, we see something that we've spoken about before. It's not new and it's not good. Prices paid is greater than prices received. We'll tell you what that means. We have a number of different components that are included in the manufacturing report. Specifically, we talk about prices received. That's what the manufacturers receive for, obviously the goods that they make. The prices paid is what they pay for the raw materials. This is actually very similar in nature to what we spoke about last week, PPI, CPI. There's a divergence, there's a disparity. So as a result, the manufacturers in this case, they're paying a lot more for the raw materials than they're able to charge. That's cutting into the profit margins. Now, in blue, Empire State Manufacturing, prices paid. That's what they're paying for the raw materials. Prices received in red, and that's what they're receiving for the finished goods. And we can see quite the disparity for a long time now. Zooming in on this, you see again in blue, prices paid, prices received in red, and the gap between the two seems to be widening over the past year or so. And that shows us a growing disparity between what the manufacturers are able to charge for for their finished goods compared to what they're paying for the raw materials. Why don't they charge more? The consumer just can't afford it. So the inflation that we're forced to face, well, the manufacturers ultimately have to face that as well. Now, also in the manufacturing sector, we have a jobs number. In particular, we see the number of employees. That's at a negative 5.7. That's actually probably the weakest component of the entire manufacturing. And what's very interesting, not in a good way, is we see here in blue, Empire State Manufacturing, the number of employees. In red, non-farm payrolls. They follow a very similar pattern to the downside. So as we see over time, the non-farm payrolls number has decreased over the past year or so. Well, we see the numbers are reflecting also a weakening state in the jobs market within the manufacturing sector. The manufacturing sector is not immune from this. So as we see a lesser amount of jobs, a lot of those jobs are being taken from the manufacturing sector. Now, in addition, next couple days, we have Federal Reserve meeting, but the Fed expectations have changed. Just last week, we spoke about this, and we said the Federal Reserve is most likely, based on the Fed funds futures, they're only going to cut interest rates by 25 basis points, quarter point. That's changed. In yellow, that's the probability that the Federal Reserve will cut rates down to the 475.5 range, which would represent a 50 basis point cut. That is now at 62%. It looks like most likely, and just very recently, this has changed. All along, we thought, we see here in red, the expectation the Fed would cut rates by a quarter point. But just this week, following last week's inflation data, all of a sudden, now we see a greater probability the Fed's going to cut by 50 basis points. Why is this important? Well, a lot of analysts have said that if the Fed does cut by half a point, this could be interpreted as a bad sign by the stock market. The stock market may panic and say, well, if the Fed deems it necessary to cut by half a point, maybe there's trouble. Just last week, we had a 50-50 chance. Now 62 to 38% chance. Taking a look at the overall scope of the Federal Reserve activities, this is what the Fed funds futures tell us. So first off, this is for the September meeting, 62% chance that we're going to get a half a point cut, 38% chance of a quarter point cut. For the November meeting, we have a 51% chance, that's the greatest odds, a 51% chance that will be down another quarter point, meaning the 450 in September. We're anticipating a half a point. In November, another quarter point. By the December meeting, there's a 44% chance that we'll be at the 425 range, which would represent 125 basis points from current levels. That means that the Fed funds futures are predicting will be down 1.25% lower than we are now. So to recap, we're now expecting half a point in September, quarter point in November, another half a point in December. What has changed? As of last week, we were expecting a quarter in September and then a half and a half. Now that's moved forward. And then finally in January, 36% chance will be at the 375 to 4 range. So that would be another quarter point. So the only real big change that we're seeing now since last week, we were expecting a quarter, then a half. Now we're expecting a half and then a quarter. It means that the Fed funds futures are predicting a more aggressive Federal Reserve earlier rather than later. Now, speaking of which, last week we spoke about this, the growing divergence between the CPI and PPI. These are the inflation numbers, consumer price index and producer price index. And essentially, what we're seeing is a growing disparity where the CPI is greater than the PPI, that the consumer is paying more than the producer for those raw materials, and that increases the profit margins. Meaning the producer, the raw materials are coming down, but the consumer is still having to pay a greater margin, so to speak. That's good for the corporations, bad for the consumer. We'll throw a link up for that video. I think that you'll find what we talked about here to be quite interesting. We hope this has been helpful. We look forward to seeing you back soon.